Good morning, everyone. It is the last day of trading here in May of 2025, and May has been a really good month if you look at the gains we've had. Today looks to be a mixed day. NVIDIA is giving up some of the gains that it had yesterday. Had a really good earnings report on yesterday, and it's giving up some of the gains that it accumulated yesterday, but it's still doing really well for the last 30 days or so. Broadcom is also giving up some gains. The whole semiconductor space is down. Marvell Semiconductor announced yesterday, and they're a smaller semiconductor company, but that stock's been selling off. Other spaces, technology has really been working. It looks like the only couple stocks that are working today is Palantir. It's up 1.25, and Palo Alto is up 1.2. I know that Zscaler announced yesterday, really good announcement, really good growth. In the pre-market, the stock was up 4%. So I don't know if it's still up. We'll take a look later, take a peek at Zscaler. Now, the staples are working. Costco, they announced yesterday, and their announcement was as expected. One thing about Costco is they're really consistent. They came in with nice 8% growth. Profitability was where it's supposed to be. They don't produce a lot of cash flow, which is one of the things that I don't like. And in the case of Costco, I think a lot of people are just comfortable with that stock. It's up 2.66% on a day when maybe investors are getting away from the riskier stocks and want to go into a consumer staple, which is why Walmart's also up. So it's a day for the staples. Looks like telecom, which acts kind of like a staple because nobody's going to disconnect their mobile phone, right? Or their internet. That's just going to stay on. It's almost like electricity nowadays. You're not going to disconnect your Wi-Fi. You just can't live without it anymore. And Netflix acts like a consumer discretionary as well. Looks like United Healthcare is having a decent day. Good to see. Very good to see. Now, we're looking at the 1 day, but let's look at the 1 month because really the month of May has been a good one. And you could see big gains out of NVIDIA. It's up 26%. Broadcom, 25%. Microsoft up 16.45%. Fabulous month, man. Amazon up 9%. Tesla up 22%. These are big cap names. You think about NVIDIA, now it's the most valuable, and we'll have to double check that because if they're down 2% today, maybe they're not. But yesterday it was the most valuable stock on the stock market. It may still be there. We'll double check. It's either between them or Microsoft. Those are big moves. 26% is like $700, $800 billion of inflows of people buying the stock up. Meta, 15% move. Really good. Google having a decent move over the last 30 days. What else is interesting? So I don't know if I mentioned Amazon up 9%. Pretty good move. A lot of things really had a good month. Disney had a really nice move, 24.25. Disney announced their earnings, and it really shows that the CEO that came back is doing a really good job. They had a CEO start, I think, around 2021, and it just didn't work. And the stock suffered, profitability suffered. But now they're back, and they're more profitable, generating good cash, and the stock really worked. Not a bad stock to be an owner of for the past 30 days. So there's a lot of green on the screen, a lot of things to be happy about. Interesting that Berkshire, they had their big annual meeting on beginning of May 2nd, May 5th, somewhere around there. And their stock's down for the month. So is Apple. Apple and Berkshire are down. So interesting. So that's what's happening kind of in general. Let's take a look at where the markets are trading at this moment. And it looks like the Dow is holding its own. It's only down a little bit, 0.022. S&P is down a little. And then the NASDAQ is down 0.54. Year to date, the S&P is hanging on to a little gain, 0.24. It's been a volatile year where in April we saw a big correction there. But over the last month, S&P up 5.89. Can't complain about that rate of return. That's a good rate of return. So I am happy with how my portfolio is doing. Really happy with it. Russell, let's take a look at the smaller cap stocks. Year to date, it's not keeping up with the S&P. And over the last month, it is not keeping up with the S&P. This index tends to be hard to read because there's so many stocks in there. There are some jewels in small caps, really good small caps. I could point to a good list of those. So it's a good place to find value in small caps, but the big caps, S&P stocks are the ones that are beating the Russell 2000. The VIX, take a quick peek at the VIX. It really went up when the markets really crashed. I think that was the day the big tariffs were announced. Hey, good morning, Saeed. Very good to see you. Hopefully you're having a good afternoon or good evening on your side of the Atlantic. So the VIX has seen its volatility, but it's pretty tame right now. Not a whole lot of trouble in the current markets. Now, there isn't any big stories, just if anything, just some rumors that the US and China are the tensions are rising between the two countries as they negotiate tariffs. Well, I don't know that that's a big problem just yet. And I think the markets are getting used to tariff news. So I don't know if they're going to change a whole lot. All right, so we went over that. Let's take a look at the most valuable stocks on the exchange, see how those have changed. See how Microsoft has just regained the title, but just by a little bit. And that's because NVIDIA is down while Microsoft is up a little bit. Microsoft, all the shares, market cap, it's worth 3.4 trillion. NVIDIA, 3.3 trillion. So just right behind it. Apple is below 3 trillion. And really all the big caps are down today. Walmart, you have to get down to Walmart being a consumer staple to see a little green. Year to date, Microsoft's having a good year, very good year. NVIDIA is in the green. Meta's in the green. Broadcom's in the green. Berkshire is in the green. So is Walmart, JP Morgan, Visa. But there are some red stocks, Apple being the one that's lost the most market cap. Apple was up there at 3.6 trillion or so. Now it's down below 3 trillion. So more than $600 billion of outflows have left Apple stock. And I don't know if they're going to go back. I don't think Apple has a terrific strategy going forward. They're not growing their company. What's the next big product for Apple? I don't know. It's hard to say because they have bombed when it comes to creating new products. And you look at other players like you look at Google Alphabet or let's say Meta, they are kind of creating their future by creating brand new product categories. In the case of Meta, obviously they have the really successful social networks, but they also have Meta AI now, and they're able to serve it to the 4+ billion people that log into a Meta app once a month. That's a big population. So I think their AI business looks really promising. And Google showcased all the products and solutions they have around AI a week or two ago and the market really was impressed with what they saw. I was impressed with what I saw, and it just reinforced what I have known all along, which is Google Alphabet is a very strong company with great solutions. So I wouldn't doubt Google going forward, so long as they keep at it, keep making these really fantastic products. I think Google will end up being the most valuable company in the stock market over the next 5 to 10 years. It's just in the cards when you look at how strategically they are put together, and it's because they built the business that way. Nobody handed them anything. They took over markets and did a great job doing so. So those are the big mega caps. We had some earnings yesterday, and before I get into earnings, if you're new to my channel, let me give you a little background on my perspective on stocks. I'm a long-term investor, and I try to find stocks that are priced at a discount. If you compare the intrinsic value of those companies, and that is driven from the cash flows the company's expected to produce. Also, look at the intrinsic value of the earnings per share the company's going to produce. Then compare it to today's stock price, and see if there's a discount available. It's the higher the quality of the stock, it's not often that those are discounted. Sometimes you have to pay fair price, but there are a lot of discounts on I would call gray companies, which are typical companies. They're investable, but at times the market is irrational. It just sells them off with a fury. So that's the path that I take as an investor. There's lots of ways to invest, and that is the way that I've made money, and I will continue to make more money and get better at it so that I could be financially independent. I could continue to grow my wealth and be successful at it. If you like content like this, consider being a member. You can join the channel. Go to my YouTube homepage. When you click the join button, you'll see the different options to become a member, and you get a lot of perks, a lot of good perks, and you can read more about it on that link. All right, so let's get into the earnings that came out. And we had a watch party to cover Costco, and it was a good watch party. And looks like Mike is on, and you want to take a look at Dow and NU. Yeah, that sounds pretty interesting. So take a look at Dow, NU, Shadow Guy. Financial independence is possible. And Kiter, good to see you, buddy. Good to see you on the stream. Hopefully you're having a nice week. All right, so let me jump into the Dow and NU stocks, and I can get into the earnings that came out in a little bit. So Dow stock is a stock that is in the materials sector, and one of the reasons that I liked Dow is that the stock had just been really, really discounted. If you look at the past year, it's down 51%. Look at the 5-year. The stock had traded much higher in the last 5 years, and the market's just really sold it off. And Dow is a materials company. They do a lot of materials, substances, glues, all kinds of stuff they go into other products. They are headquartered in Michigan. So when you think about the automotive industry, and you think of a lot of industries and global companies, they look to Dow for a lot of those materials they need for their products. They have a nice dividend yield of 10%. So let's make sure that dividend is safe, because that's a pretty attractive characteristic of the stock, especially for investors that are looking for income. So I'm going to make sure I think about the dividend and make sure that it is something they could afford and will keep. And the reason for the high dividend is the stock has come down 51% over the last year, and really since, let's call it April of 24, stock's up 53%. Geez, it's kind of, as mentioned earlier in the comments, sometimes the market's irrational. It just sells off a stock pretty much, without reason. And I think that's the case here to some extent. When we look at their business, it is a business that is going to do okay. And let's look at their financials, see how the company's been performing, and then we'll assess, what should the price be for Dow, and can they afford that dividend? So market cap's really low. It's 19.79. That's like super low. I mean, we just got done talking about NVIDIA, and NVIDIA's 3.3 something trillion. And this guy's at 19.79. And Dow's been around for a long time. Net income is there. The PE ratio is really high. Forward PE is really high. We'll investigate that, see what's going on there. Of course, the dividend is really high. Analysts think it is a discounted stock, 38% discount. We looked at the price chart, so I don't have to cover that a whole lot. Now, when we look at the revenue, this has been cyclical. We've had periods where revenues contracted, and then they really expanded in 21 and 22, and they've been contracting for a couple of years. Looking at the quarterly, the contraction continues at the quarterly single digit, not too bad, but it is a contraction. And it's not like overly worrisome, right? It's not like, oh man, it's just really just the business is getting destroyed. They're still a $42.6 billion revenue company. That's a pretty big company. So let's take a closer look, make sure I'm in the annual, looks good. So when we look at, so the free cash flow is negative. We're in a period of time when they're doing something, and I'm going to take a closer look at their cash flow, see if we can figure out what have they been doing. But historically, look at this cash flow. Really decent cash flow. You're talking about a less than $20 billion market cap company that in 2021 produced 4.5 billion of free cash, 2022 5.2. That would be a very high rate of free cash to a company. So if they can get back to even 2.5 billion of free cash flow, this stock is discounted big time. So we're going to look at that and see if we can determine, are these guys going to get back to free cash flow levels? And while I'm at it, let me take a look at the quarterly and see how the quarterly has been behaving. See if the quarterly tells us, hey, they're turning the corner on free cash flow, or maybe they're not. So they've had kind of so far the last 3 quarters are negative. They had a positive quarter here, then they had some positive quarters, looks like a year and a half ago. So not quite turning the corner. So we'll keep looking. We'll keep looking at this stock, beating it up, making sure that this is a decent company that is investable. It's on the rebound. Once the market sees better numbers, stock's going to flourish. So gross margins are low because it's a materials company, but they are lower than historic rates, right? 2019, they were 14.8. In 2022, they're 15. Now they're down to 9.56. What is going on there? So there's the free cash flow margin. All right. So here's the EBITDA. EBITDA is still decent. I think there's some costs that are going on after the EBITDA rate. So we'll take a closer look. Now I'm going to go straight to the financials from the company because I feel like it gives me a better details than what Stock Analysis, the website. Stock Analysis, the website, they do a nice job, but they tend to bring all these numbers and put them in a general category. And I want to get rid of like the general terms, and I want specifics directly from the company's website. So let's take a look at that. All right, so here's the financial results. So launches action plan to further reduce spending, right-size capacity, and deliver $6 billion in cash support. So they're on it. They're trying to reduce their spend. And you know how they had those negative figures? It may be that they had layoffs and they're paying a lot of severance, you know, for the people they had layoffs. So let's keep reading. So net sales were 3% down. Okay, we're aware of that. And they do performance materials, coatings, and so forth. Okay. Volume did increase. So I guess the price of their product is where maybe they're not getting the price they would like. They'd like to charge the highest price possible, but in the case here, their prices are down. So cash from operations was down. Here we go. Primarily driven by earnings pressure from continued soft global industry demand. Okay, so they're seeing soft demand globally, which would align with they're getting a lower price for their product. They are not, you know, it's not like a booming economy where like there's shortages and they can increase prices and their customers would still buy it because there's a shortage. Nope, it's there's less demand, and therefore customers are probably negotiating harder and getting a better price. Okay, so here's where they're trying to make a difference: reduce spending, right-size capacity, deliver cash support. So they delayed construction of a project. Good idea. Expanded. So this one here. So they expanded their European operations. Okay, taken together, these new and previously announced actions total approximately $6 billion in cash support. So they're going to sell some assets. So that's one way. They're going to get a judgment in their favor. That's $1 billion. $1 billion of cost savings. And they're going to reduce CapEx. So they are trying to turn things around when it comes to cash. Okay, so they are focused on it. Okay. All right, so so sales were down, and you know what? Let me get to an income statement. I like going through the income statement. So here the company tends to slice and dice their financials, and I'd rather see the whole picture and look at the categories myself. I'm going to come back to the outlook, but let me look at the financials first, and then we'll come back to the outlook. Okay, so here's statement of consolidated statements of income. Okay, so sales are down. Now they're not like falling off a cliff, but they're down. Cost of sales is up. So they're seeing a little bit of that inflation creep into their product, and their customers asking for a better price. It's a soft market, so they have to give that better price. Okay. Research and development is about the same. selling and administrative costs did go down. Good job on that front. All right, amortization of intangibles. Okay, so this is restructuring and asset related. This is a charge when you're restructuring the company and you may have to be paying severance to some folks that you let go. So that might be one of the things that is eating up cash and eating up some of their profits. These other figures are little. Interest expense went up. Okay, so we'll take a look at their debt level. Make sure that's not getting too out of hand. So they lost some money. You could attribute some of the restructuring, 200 million, because that's part of it. They're getting, I think what I would point to is they're not getting the higher price that they would like because it's a soft market, so that's lower revenue. They're seeing some inflation in their business. That's where there's almost $300 million of additional cost going into their product cost of sales. And then they had 200 million of restructuring. So that alone is 500 million, and that's what led to the loss in that quarter. Okay. And that's what led to the negative earnings per share. All right, so that makes sense. I'm not expecting this to be a normal reoccurring cost. It's going to be like a one-timer, okay, and it should go down. So that's going to help. Second thing is, with regards to their sales price, I don't know if that's going to change very quickly. I think it's going to take a little time for prices to get better. And on the inflationary cost of sales, I don't know that that's going to change very quickly. The good news is the tariffs seem to be less of a threat overall to the economy and to companies than it was initially thought of. If we got into a long-term, ugly tariff war, their costs would go through the roof, and these guys would be in worse shape. So the items up here aren't going to change all that slow, but I think this item will change. If they can reduce more cost out of the business, maybe they can break even. We'll see what they're forecasting for next quarter in the outlook in a bit. So assets, they have 1.4 billion in cash. All right. Let me note that so I can refer back to it. And we've got, okay. Inventories have been built up a little bit. Got to be careful if in a soft market, you don't want to build up your inventory too much and then have to write off inventory. So notes payable in the current section, 136. So we have to add what's in the current section plus what's in long-term. So let's find what's long-term debt. So long-term debt, okay, this is due within one year. So I have to add that, 502. And then long-term debt is 15,932,000,000. Okay. Statement of cash flows. Let's see where this is landing. So they had that loss, understood. Depreciation, fine. So this provision for credit for deferred income taxes kind of acted against them on the cash. That should be a one-time issue. So it shouldn't be coming back. It should be a one-timer. Okay, so this is earnings from affiliates. I think they have like joint ventures and minority stakes in companies. Okay, so the restructuring, they took the charge, they haven't paid the cash yet. So that's added back to the cash statement. the accounts receivable, accounts receivable, the balance went up, meaning their customers owe them more money for product that was sold to that customer. And in this case here, they are having to use a lot of their cash to send out the product, and then that customer is going to take a while to pay them. So that's a negative. Once they get their customers to pay them, that'll turn positive. Inventories were built up a little bit. So all these things are kind of acting against them. I think they're not going to build out inventory. I think they got to get on their customers to pay them, obviously. And that could really turn things around on the cash from operations front, and then turn their cash position more favorable, improve it. So that's where we're at with the statement of cash flows. Now let's take a look at, and then CapEx did go down a little bit, but overall they're in a negative cash situation. Now let's look at the outlook and see what they had to say about their outlook. All right, so outlook. We continue to implement decisive decisions to address persistent slow GDP growth, increased macroeconomic and geopolitical uncertainty, so they didn't talk about guidance on going forward. So, okay, so that's where we're at with the financials. They're in the process of turning things around, okay? And they're probably like 50% into it, give or take 10, 20%. They may be closer to the end or further from the end than I would think. Now let's take a look at a couple things. So first, can they afford the dividend? And so the payout ratio, and this is stock analysis, they're trying to get to it. So I'm not going to go there. I'm going to go, let's take a look at the cash flow statement and look at the trailing 12 months and last few months. So cash from operations has been decent, 2.5 billion being the low point, but historically it's much higher. And what I'm banking on with this stock is that it's going to revert back to what it's historically done, get back to 5 billion in cash from operations. And I think they can do it. This is a very well-known business. So if they can get back to 5 billion, they pay about $2 billion in dividends. So they should be able to afford that dividend, but they have to get back to that rate of cash from operations. And at this point, they are at $2.5 billion. So they can barely afford it. I have to say it's a little tight, but if they can increase this number, I think they had some one-time events this quarter, and get it up to 3 billion, 4 billion, 5 billion. If they're at a $5 billion free cash flow from operations figure, that dividend should be okay. And they didn't speak about reducing the dividend, right? So let's take a quick glance at it, and I'll do a search here. So they return dividends. They're proud of that. And they paid dividend stockholders about 500 million per quarter. We knew that. So they didn't comment on, hey, we're going to have to reduce the dividend. And I don't know if they have any more news on that. Let's take a look. So they sold a business or a product line. So I'm not seeing any comments on the dividend. So for now, I would say if they recover, the dividend's going to be fine. If they have more issues, the dividend's on the table. It has to be on the table. The longevity of the company is most important, and they have to do whatever needs to be done to make sure this business is a viable business in the future. So now let's look at debt. So I'm kind of taking my time on this one, and I'll take my time on the stocks we're going to cover. And I saw that Nkiter, you want to look at CRM. Glad to look at it. So just bear with me. I want to make sure we cover all bases on all stocks we cover today. All right, so balance sheet. I think this is where it's going to get a little ugly. So debt to EBITDA is 3.03. They're okay. They're right there at the limit. So they got to improve, because if this gets uglier, it just adds more to the concerns. So we're right in kind of like the trough, the low point. This is where they have their backs against the wall, so to speak. Kind of like the New York Knicks last night. I think they won. I turned off the game because it was kind of pretty good lead. They're down 3-1. If they don't win, they go home. They stay home because they played in New York. And they really played hard. So Dow, they have to play hard. It's go time. There's no room for error anymore. Having said that, let me show my valuation on Dow. I still feel comfortable with Dow. I think the business, right? When I look at a business like Dow, do I expect they're going to come back? Yes, I really do. I think that this is a business that's integrated in so many other companies. When they are looking to paint a particular product, okay, it's going to be the Dow paint and coating. When they look at certain ingredients or materials that go into a product and are part of a bill of material, it's going to be that Dow product. So that established kind of book of business is going to bring them back if they could just operate well. And I think that it's discounted by 40% collectively. I think on the cash, they're going to revert back to their 4-year average, which is $3 billion. And that's a pretty low bar, in my opinion. I think they could do better than that. And if they do better, then the stock's going to flourish. So I still feel like, hey, this is a stock that is going to do okay. Over the last month, it's really sold off. It's provided plenty of opportunity for investors to buy into this company if you believe they're going to make it. I certainly believe they're going to be fine, and they're going to really revert back to what they've done historically. And this stock can get up to $60 a share. And in the meantime, pay a nice dividend. So overall, that's what I see in Dow, Mike. Kind of like check my homework, and that's where I landed. So hopefully, let me see if Mike, if you want to comment any other questions, comments. Love to hear it. Let me catch up on comments while I let you kind of comment on that. So Nkiter, you want to look at CRM? Most definitely. We can look at Salesforce. It is really surprising how the stock market treated the Salesforce stocks, and I'll make more comments. So you like Dow, you've been dollar cost averaging into the stock. Excellent. And let's see here. So ex-dividend date for Dow is today. Is that right? So it is today. So if you own Dow today, you're going to get that nice dividend, 70 cents a share for the quarter. That's not a bad dividend at all. So you get paid a really nice dividend rate, and if the company recovers and they go up, I think it's a $60 stock. You win two ways. It's like 3M. This reminds me a lot of 3M. 3M is similar, bigger than Dow, and they also do provide a lot of materials that go into other products, and other businesses use 3M as kind of a source into their bill of material or their recipes for a product that's made more in a process manufacturing environment. And these guys certainly had their troubles, and the market was like, man, 3M, you guys are a bag of jerks, and we're going to sell you off by 58%. Now, I just think very highly of this company, and I know they made some mistakes, and I know some people got hurt, and but in general, I think it's really good company. And I started buying, and boy, it's gone really well. So you make money on stock appreciation, beautiful, up 106%. And while you make that money, they pay a dividend. Now, the dividend doesn't look all that fantastic, but keep in mind, when it was priced at $73 a share versus 149, you were being paid 4% dividend. So if your cost basis is down here, the dividend looks great, and your stock has gone up. So this worked. This worked for me. So can Dow follow this trail? Maybe. I think it will, but it's still undetermined. We still got to wait for it to do it. It's not going to automatically do it. So that's our friends at Dow. I noted CRM. We're going to cover that. And let's see here. So Shadow Guy, I'm not sure I would beat up companies. True. Bushy, 1147. Good to see you. Hopefully you're having a good day. Thanks for joining. Glad that I answered your questions on Dow. All right. Let's see how it works. Hopefully it follows the journey that Dow, that 3M followed. So let's look at New Holdings. New Holdings is a completely different animal. New Holdings is a company that is a variety of financial services, and they do financial services in Latin America, and they operate quite a bit in Mexico. And give me 1 second here. I just have to write something. All right. So what I like about New Holdings is they remind me a little bit of companies here in the States that do a really fantastic job. You know, companies here like the Robinhoods, the banking industry, even SoFi, but these guys do it down in Latin America. They do a variety of financial services. Let's view their website just to kind of get our heads around it, and then we're going to do the same thing that we did for Dow. Take our time, cross our T's, dot our I's, and I'm going to go English. I have no Portuguese ability. It sounds awesome when I hear people talk in Portuguese, by the way. I could listen to it. It's like music to me, but I cannot speak it. I speak Spanish fluently, and Portuguese just sounds so different, but it sounds fantastic. It sounds a little bit like a different sound, but similar to French. All right, so they have Nubank, they have credit cards. So let's take a look. So they have their credit card processing. Okay, so this is like their banking, insurances, NewPay for payment app, and then they do bank transfers, or I should say money transfers to one another. That's a very prosperous, fertile area, right? People move money to one another quite a bit. So that's their industry kind of like overview. Let's take a look here. Yeah, right. So this all resembles kind of like stuff what we see here in the States, but it's really geared to Latin America. Now, why am I going into Latin America as an investment? Well, first, most of my investments are in the US and they're going to stay in the US. But it's good to diversify globally a bit and and tap into economies that are doing well. In Latin America, you're seeing a growth of their middle class. You're seeing people uh, get, smartphones, get their smartphone, download apps, and start transacting. Those are organic new customers into a connected digital finance industry, and I think that is where it gets exciting for new. Here in the States, United States, we've had online banking for a long time, 25 years, and we've had apps to do our banking, and we've had Venmo for a long time. So we're accustomed to it. But I think that there's so many people in Latin America that are doing that for the first time and really beginning to grow the amount of volumes they do there. And New is strategically positioned to take a good portion of that market share. It's not like American companies could go down there and understand the region, understand their cultures, how they do business, how people like to transact and so forth. But New has the cultural advantage, and I think they're going to do well with it. So that's kind of like the big picture why I think it's interesting. Now, that's big picture. Let's look at the numbers and see if the numbers tell us a good story as well. So the market cap of the company is 57 billion and the revenue is 5.6 billion. So you're paying a little over 10 times sales, just a tiny bit over, like maybe 10.3. P ratio is 27, forward P is 20. Analysts think it's discounted by about 27%. Over the 1 year, it's stocks breaking even. Year to date, stocks doing well. Nice, good to see that. It's had its moments when the stock was really priced low. I like their revenue growth, really solid growth here. And it's been growing, 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 growing. And we have top line getting bigger and bigger. So operating revenue and overall revenue has gotten to a substantial amount. And this is on US dollars. So they are headquartered in Brazil. So I think their financials will be in the Brazilian currency, but they convert it over to US dollars. So the growth is really good. Let's look at the quarterly. And the revenue growth is slowing down to 10%. That is a concern. It's like, what's going on, guys? You're hitting a wall, or, how could you go from in 4 quarters from 72 down to 10? And they'll have to pick up the growth. If they don't pick up the growth, I'm concerned. So I'm going to give them a quarter. When do they announce next? So they announced on May 13th. So add 3 months. So I guess it'll be around August 13th when they announce again. So in August, I'm going to look at their financials and see if they can grow 20, 30, 40%, this stock's going to fly up, and all those concerns in my mind are going to be lowered substantially. If they come in with single digit growth, I'm going to be even more concerned. So I'm watching the revenue growth. Remember, revenue growth tells me more customers like what they're selling. They are attracting more new customers. The customers they have are buying more products. All those are positives. A contracting number means the opposite. Customers are leaving. Customers are buying less. Customers are canceling services and so forth. So that's where we're at there. Profit margin is excellent. And we're not going to use free cash flow. This is a financial company similar to a bank. We're going to look at the book value, and I value banks based on book value and earnings per share. So the book value, you want to see it grow. It shows that you're adding more and more value. If you want kind of a good case study for book value, see the book value here is going from 54 cents up to $1.78. That's an A+ grade on book value growth. The gold standard for book value growth is JP Morgan. I was a long time JP Morgan investor. I did well with the stock, happy with the stock, don't own the stock anymore. And when you look at their book value growth, it's like textbook. It's $1.19 now. It was 76 in 2019. Growing, growing, growing. Meanwhile, when you look at the JP Morgan stock, geez, my typing is off on this Friday. So if we look at the JP Morgan stock, up 171%. So book value of JP Morgan has consistently gone up, showing that, hey, we're doing things that are adding value to this bank, and the stock has acted in the same direction. As book value's gone up, so has the stock price. So that's something that I keep an eye on with financial institutions that act as banks, because banks hold a lot of reserves or hold a lot of deposits, and then they lend out the money. They pay some interest to depositors. Maybe they pay 3-4% currently, and they lend out at 7-8%. And that differential is where their profit is. The net interest margin is where their profit is. All right, so that's that. So the red flag was revenue growth. They have to keep growing. They don't grow. If they contract, I am going to be really nervous about it, concerned about it, and we'll be looking for answers on why they're not growing. Give me a second here, try to find the valuation. I guess I should say new holdings. All right, found it. So we're basing it on a book value growth and earnings per share. Earnings per share has a good valuation of 33%. The book value, let's see here. So discount rate. One second, guys. I'm just trying to get back to my analysis. I haven't looked at this analysis in a while. So here's our book value. Book value is expanding at 16.9%. Looks good. So based on earnings per share, this stock is so they're expecting to do 59 cents of earnings per share this year. So I'm going with 59. They're growing really well, but they're international stocks. So I got to either increase my discount rate or decrease my PE ratio. So let's go back to their valuation. It's 59 cents per share. PE at 24, growth rate of 20. We are going with a huge discount rate of 14%. That's huge. Actually, can probably go 11. Okay. And it's, I mean, the stock is discounted at 30%. What's the stock been doing recently? Man, that is a roller coaster chart. So the stock is up 14%, provided opportunities to buy into the stock at a low price. The things that are tailwinds for the stock is it seems like the tariff conflicts are subsiding. And I don't know that any Latin American countries have kind of gotten center stage on the big conflict with the US. It's primarily China. And I think the economies down in Latin America should continue to operate well. You think about what we get from Brazil and other places within Latin America, we're getting a lot of food product, material product. It's a source of a lot of inputs into our economy. So I don't know that those are going to be disrupted. And they also sell those products to Asia. They sell them to Europe. They sell them to other parts. So I think their economy is going to be good. I think New Holdings is going to do well overall. The stock really flourished coming out at 23, and it's kind of plateaued. It went up really nice, but it's kind of plateaued from March for 1 year. It's pretty much hasn't done anything. So it's still a hold for me. I'm not buying additional shares, and I like the diversification down in Latin America. I own a couple stocks outside, the US. There's New Holdings, Mercado Libre down in Latin America, and then TX down in Latin America. In Asia, I own Alibaba, I own Futu, and I own an ETF that owns a basket of stocks in China. In Europe, I own an ETF. And I probably own a couple of other European stocks, like Chubb is headquartered in Switzerland. And I own an India ETF as well. Now, 90 some odd percent of my stocks are US based, and the value of my stocks US based. So diversifying it outside is not a bad idea. And I own a little BHP. That's considered in Australia. It's considered part of Asia, so I guess I could put it into the Asian kind of category. So New Holdings for me is a hold. And what's it been doing over the last month? So over the last month, it's down, and it's been down 12% over the last 15, 16 days. So that is a pretty good drawdown. I'm not ready to buy more shares. I don't think the news is bad. I think they have to keep growing that top line. If they can keep growing that top line, we're going to be all right. I think that what they do in financial services makes a lot of sense for that region. So kind of like the economic story makes sense to me. The fundamentals are good enough for me to be an investor and put a small position into New Holdings. So that's my analysis on New Holdings, Mike. All right, let's head into CRM. And as I head into CRM, I'm going to check the comments. We've got a lot of people on the stream. Thanks, guys. Thanks for joining. And we're going to take a look at CRM. But I'm going to check the comments just to not keep everybody waiting on questions they had. So, Saeed. So Dow should be kept just as legacy looking at this price. Okay. Cool. So Shadow Guy. Yeah, down in Latin America, it's interesting. It's very cash oriented, but that's quickly changing. I don't travel extensively in Latin America. I mean, the furthest south I've gotten is Mexico City, but even like street vendors are like accepting credit card, debit card, payment, electronic payment. And and they're doing it on their phones, and they have, an attachment to their phones, and you're good to go. So the world is changing rapidly, especially in some places where maybe they were lagging, maybe 5, 10, 15 years from where we're at here in the States. And that's really exciting for them. It provides a lot of value, it provides more liquidity. It's like a lubricant for the economy. If you all of a sudden have different forms of payment, cash, credit card, payment, kind of like buy now, pay later kind of programs, it's going to create more commerce, and that's good for them. It's good for the companies that are going to provide that service, that financial service. So, Mike, hey, Shadow Guy, did you know that as of 2021, a staggering 1.9 billion people globally were unbanked? Wow. 122 million of those were in Latin America. Okay. Yeah. We take a lot of things for granted, where some people are like, wow, cool, I'm going to drive a car for the first time. Oh, I'm going to, open a bank account for the first time. Those are really cool things for people. Thanks, Mike, on the feedback for new. Let's get into Salesforce. So Salesforce announced their earnings, and surprisingly, their stock sold off. And it's been my observation. I've provided these comments. Now, I have a lot of experience in the software space, and became a fan of Microsoft 35 years ago, if not 36, 37 years ago, because I saw Bill Gates create this massive company, massive wealth, and because software companies are so darn profitable. So I've always had this preference for software companies because they drive high profit margins. Their businesses tend to be really sticky. Like when you buy CRM software, when you buy software from Salesforce, and these companies implement it, it's really hard to replace it. It's not like, you go to Starbucks to get a cup of coffee and you stop liking their coffee. Like, man, their roast just isn't getting it done for me. So I'm going to go to Dutch Brothers. Oh, or Dunkin' Donuts. Oh, their coffee tastes better. Switchover cost is nothing. It's easy. You just go across the street. Where when you have Salesforce, no. You want to change your software, it's like a 2 to 5 year plan. It takes a long time. You have to retrain your employees. You have to redesign, redevelop your business processes. Needless to say, it's a very sticky business. I like that. Why? You have high margins and your customers aren't going anywhere. What's there not to like about that? So, so that's why I like software businesses. So let's get into Salesforce, examine the fundamentals and see what the heck's going on. Sometimes the stock market is irrational. I might even call it crazy sometimes. Sometimes it's just out of touch. And with Salesforce, it drove down the price of the stock by 34% very recently, starting in January. Now, there's some stories that are stories, and they may become reality, but for now, they're stories, which is, AI is going to put agents out there, and the need to license as many seats for employees is going to go down. That may be the case 10, 20 years from now. But between now and then, Salesforce is going to continue to make the money they're making grow and potentially harness the AI paradigm and create a new, fantastic new business. And that is the opportunity. It's both. AI could be a humongous threat or it can be a humongous opportunity. And I think Salesforce has the intellectual capital, strength, and muscle take advantage of the AI paradigm. So that's my point of view on kind of macro level, high level, how strong is Salesforce? Now let's get into fundamentals. So Salesforce CRM, Symbol CRM, is a pretty good market cap, $252 billion of market cap. Revenue is $38.5 billion. And their PE is a little high for their current year at 41. Forward PE looks good at 22. Analysts think it's a buy and it's discounted. Okay. We already went over the price charting, so we don't have to go into that too much. This is where I look at this company, I'm like, what's the big problem, stock market? They keep growing their top line. And they keep making their business bigger, bigger, and bigger. And they just acquired or formed an agreement to acquire Informatica. And I do know Salesforce quite well from what they do in the marketplace. Informatica is not a solution that they currently have. And I think it's going to be organic. It's going to be a net increase to what they can do and a net increase to the revenues they bring in. So it's a positive. The revenue is at 8% growth compared to, this is trailing 12 months. And if you look at the full year, FY25, which ended January 31st, not too long ago, it was a very good growth rate at 8.7. Now let's look at the most recent quarter. Most recent quarter, 7.6. All right. I don't see any alarms. That looks fine to me. Let's look at gross margins, free cash flow, and all that good stuff. Now look at this free cash flow growth. Textbook. That is a beautiful upward slope of free cash flow. So meanwhile, the stock is getting sold off. Their cash flow is going up and their cash flow is expanding and their stock price is getting sold off. Interesting. Gross margins, 77%. 77% gross margins. Operating margins are good. Profit margins are good. Free cash flow margins are excellent. Why do they create so much cash? When you develop a product like Salesforce, it's an intellectual property product. It's code. You wrote it, and to oversimplify it, you write it once, you sell it to 1 million customers. You don't have to rewrite it 1 million times. It's not like when you sell an iPhone, there is a product cost involved. Every iPhone you sell, if you sell 1 million units, you have to buy the parts for 1 million separate units. You have to hire people to assemble 1 million units, ship them out, handle them, pick, pack, ship, and then bingo, you sold 1 million units of an iPhone. When it comes to software, you sold it to 1 million users, 1 million seats. They download the product, and literally the delivery of that product is instantaneous and close to zero cost. That's the advantage of software businesses. That's why I like them. I like the profitability. It's almost like the Visa model where Visa doesn't, well, they established the network, everybody trusts the network, and then Visa is so profitable in their network that they make very high margins. They're very sticky, really good business. Salesforce is different, but similar in the very desirable attributes: high margins, high cash flow, sticky, has barriers of entry against their competition. The number one player in CRM software is Salesforce. Number two is way behind them, way behind. Nobody can come close. ServiceNow competes on the service automation aspects of software. They do a good job, but ServiceNow is smaller than Salesforce. Having said that, let's take a look at other fundamentals. Okay, so I'm good with revenue growth, good with cash flows, good with margins. Balance sheet's in great shape. They have more cash than debt. Let's take a peek at what analysts are thinking on Salesforce. Now, some analysts are quite optimistic. Maybe they're a little bit like me. They think the stock's worth $450 a share. On average, analysts, 35 of them are putting in their 2 cents. They think it's worth 346, and the worst case scenario is down at 225. So when we look at the forecast, and 55 analysts have contributed to the forecast, we're in this year already. This is fiscal year 26, which is going to end January 31st of 2026. We're already operating in this year. The revenue is going to grow at 8.78%. Earnings per share is going to really expand fast, 77%. And next year, revenue is going to grow at 9%. It's probably going to be better than that because Informatica might already be in those numbers. And the earnings per share number is going to grow by 12.44%. So you see that the PE ratio is really going to get reasonable fast. So those numbers look good. So 1126. Now I've done my homework on CRM. It was part of the NVIDIA watch party that I hosted with Daryl. Daryl did a great job on that, by the way. That guy brings a lot of value. He's really smart. I think you guys probably agree with that. And really enjoyed streaming with him, and I plan to do it. And we primarily looked at NVIDIA on Wednesday, and what announced around the same time was CRM. And of course, nobody paid attention to CRM. Everybody's, what happened to sales? What happened to NVIDIA? All right, so let me make this a little bigger and make sure you guys can see it. All right, so here we are. This has been updated. The free cash flow, I'm using 2024, I'm growing by 8%, which is rational. They're growing the revenue by 8%. And the free cash flow forecast for the next 4 years, the growth is there, so it should continue to expand. That looks good. And then grow terminal value or terminal growth will be at 4%. They have a terrific balance sheet where they have 17 billion of cash, 8 billion of debt, so 8% discount rate. That's the same discount rate I'm using with high quality balance sheet companies. If you noticed earlier for Dow, I used 9%. So Dow's a good company, but they're holding a little too much debt, so I'm discounting it at a higher rate to get a better discount. We looked at new holdings outside my home country, 11% discount rate. But for CRM, we're going with an 8% discount rate. So at the intrinsic value, the net present value of all the cash flows I expect the company is going to produce, discounted at 8%, is 348 billion. I'm going to add the cash on the balance sheet, but take away debt, get to an equity value of $357 billion. If I compare the value of cash flows per share versus the current stock price, we have a discount of 30%. That's a pretty rational discount on a very, what I feel is a very mature, well-known, reliable company in Salesforce. When we look at earnings per share, we have 1126, PE of 25, growth rate of 9%. It's a little higher, but it would be conservative. It could grow at 12 to 14%, but I'm gonna go with 9 and get a 14% discount. So overall, 25% discount on Salesforce. It is a buy for me. Salesforce, in my mind, is a company that has terrific competitive barriers to keep its competitors out. And the reason why, that in combination with the fact that they have terrific margins. So why would they want to keep competitors out? Well, it's to take advantage of all these awesome margins, right? You have margins of 77%. You have free cash flow coming out of your ears. Of course you want to keep competitors out. Competitors would love to come in and take Salesforce out, but they can't. Salesforce is number one in Salesforce automation, and businesses are not going to sacrifice their revenue and cut over to a new Salesforce automation tool, which their salespeople, their inside salespeople use, they're not going to sacrifice their short-term revenue just to try a new product. And frankly, the next competitor in the space is really hard to think who it is because they're so far behind. So competition-wise, they're an A. Network power, I'm gonna give them a B because it's not a Microsoft. It's a good company, but it's not super powerful. A on balance sheet. Revenue growth, I would say, okay, they're not growing at incredible rates, so I'm going to give them a B. Profitability is an A. Cash flow is an A. So I would put Salesforce, and this is not fitting the screen, so let me make this a tiny bit smaller. Here we go. And I would put Salesforce right about here. They do have a lot of competitive advantages, barriers of entry, like where competitors just can't come into their space. It's going to take a long time to disrupt Salesforce. Microsoft doesn't really compete against Salesforce in their space. They do this really, really well. Now they're not growing a whole lot, which is probably my biggest dissatisfaction is the revenue growth, but they're still growing. So getting those high profit margins and high cash flow is a pretty good idea. Now, since they are dipping into the gray, I want a rational discount. If they're like a Microsoft, geez, I'll buy them at fair value. I'll buy them near fair value. I might even pay a little premium. But for Salesforce, I want a discount, and a discount's being offered at 25%. So I'm buying Salesforce stock. I'll buy it. Thank you very much, stock market. I think you're wrong, stock market. I think I'm going to wake up and this stock's going to be a $350 stock. So I want to buy it while you're discounting it for me. Thank you. Over the 1 year, the stock's up 20%. Over the 5 year, it's up 50%. It's underperformed a lot of peers in technology. But if you buy at the right time, if you bought at the end of 2022 and over the course of 2.5 years, you're up 105%. So it shows that investors will buy Salesforce if you price it right. And right now, I think it's priced really, really well. So there you have it, Nkiter. That's where I'm at with CRM. As is the case with some stocks, is they're misunderstood and priced incorrectly, whereas some, I guess, affluent investors would say is they're not priced efficiently. I don't think Salesforce is priced efficiently, and I'm buying shares. So it's a good opportunity for me, and hope you found my analysis interesting. Thanks, guys. You guys brought really good stocks to take a look at. Let me do this. Let me take a quick break to get some coffee. And you guys hang tight. If you guys want to queue up some questions, some stocks you want to look at, please do. And I will be back in just a few minutes. So let me put up a banner that tells everybody I'll be back. Just hang tight, and I'll be back in 3 minutes. All right, guys, I am back. Thanks for the quick break. I was able to catch my breath and see what we're doing. All right. So, so Mike, the dividend investor guy. I love your style, Mike. You need Salesforce to be under $200, $260 per share. We're getting there, buddy. We're getting there. Just another tranche down or another move down, and we'll be at $260 a share. And how do you make $1 million in 2 years starting only with $10,000? Man, that's a tough one. Yeah, I just wouldn't think along those lines. I would say that, how did I make my first $1 million? Well, first, I worked hard. Professionally, I improved my marketable skills. I got into a profession that paid really well, paid me above average income, and had really good bonuses attached to it, and was able to accumulate capital by having more money than I needed to live on. And I started accumulating that capital. The levers that took me up were real estate investing. I did buy into real estate, which was a good move in Southern California, and buying real estate in the 90s and then buying real estate again in 2010 when nobody wanted to buy real estate was a really good idea. And then stocks. So some stocks, like overall stocks, have returned, man, some years I made 25, 30% rate of return on stocks. So that's just continued to compound. What's interesting is I'll have to think back and see how long it took, but I think it took a while to get from 0 to 100,000. I don't know, it took maybe 5 years, maybe a little longer, maybe like 7. And then to get from 100,000 to $1 million took like 4 years. It was faster. And then to get from 1 to 2 million took like 2 years. And from there, it just keeps accelerating, which is great. And that's the magic of compounding. So that's the response I would put out there. Now, if somebody said, no, really, I want a response on, I have 10 grand and I want to be a millionaire in 2 years, I just don't see a path that I could lay out there without the person having to take extreme risks. And you go, and there's a 90% chance you're going to have $10,000 today and 0 literally in a year, because you took so many risks that your capital has been depleted. So that just wouldn't be the right question for me. I wouldn't be the right respondent. I'd probably be like, that's not the game that I'm playing. I'm playing the long game. I would instead say, hey, I would improve your revenue, your revenue making ability, which is either through profession, employment, small business, big business, and generate new capital that you can put into your portfolio, and then get on a path to just continue to expand your wealth without putting your wealth at extreme risk. Because I guess at 10 grand, you're not wealthy, or you're not like overly wealthy. So you might be more risk. Your ability to take on risk might be there. But even, my sons, right? They're 20, 24. I'm not setting the expectation that, hey, you're going to be a millionaire in 2 years. Nope. They're doing great. They're going to do fine financially in life, I think. But 2 years is just, I just can't get my head around that. A-Lab. All right, let's talk a little A-Lab. What's going on with A-Lab? So ALAB is down 6.77. It had a decent day yesterday. I was a little surprised it didn't rise more yesterday with the real good news around NVIDIA, but it's really selling off. Now, ALAB is a smaller cap. Let me take a quick peek at how stocks are doing in general. That might give me a clue as to what the market's doing today. So NVIDIA is selling off, and ALAB is coupled to NVIDIA because ALAB is part of the data center build out. So, and we'll, Saeed, we're going to look at ALAB. We're going to do exactly what we did on the other stocks previously. We're going to go step by step, look at every piece of it. All right, so NVIDIA is setting the table for the rest of the semiconductor industry. It is down 2.22%. All right, and ALAB is down in greater proportion. The reasons for it is there's less confidence in a smaller cap, right? Just high level reason is this is a $15 billion market cap company, tiny. NVIDIA is 3.3 trillion. Everybody knows NVIDIA. Confidence, in NVIDIA is there. Astera Labs is like, who's Astera Labs? They have a really neat technology, but who are they? And their price action has really proven that when investors get excited about it, boy, they just get too excited. And the stock went up 283% in just a few months. It's also collapsed by great levels just over a few months. So what are we dealing with? Now, over the last, call it month and a week, stock's up 63%. So what is this stock all about? Is it a long-term hold? Is this a short-term hold? What's it all about? Let's take a look at it. And I'll give you my plan with the stock as part of this segment. I hit the wrong one. All right, so here's ALAB, and market cap 15 billion, revenues 490 million. So investors are having to pay about 31 times sales, and as you'll see, their revenue growth is super high, so it's somewhat rational when you're paying that kind of price to sales ratio. PE 352. What is this, Palantir? The forward PE is 65. Again, we're going to look at sales growth, and sales growth is super high. Analysts think it's a strong buy, discounted by 8%. All right. So this is where it gets really interesting, is 200% revenue growth. It's very rare to find a company growing that fast. And they're not like a $1 million company. It's 490 million in the trailing 12 months. Quarterly, they came in 144 million. When was the last time they announced? May 6th, so close to a month ago. So this is one of the things that catches my attention is, wow, why are they growing so darn fast? Well, as I've mentioned before, what does ALAB do? Well, let's go there. Let's go there for a minute, because I think it's important to understand the big picture on this company. Any company you invest in, try to understand the big picture. What are these guys doing? Like Dow, right? Dow is a super old company, been around more than 100 years. I understand the big picture. Those guys, everybody knows Dow. They're part of so many bills of material and so many recipes. When other producers or products need materials, they go to Dow. That's the big picture. What's the big picture for Astera? Why the heck do these guys exist? Well, it's because you have data centers being built out. And why are data centers being built out? Is companies are taking big sizable workloads to data centers like AWS, Microsoft Azure, Google Cloud, and they're running these big workloads. Workload, you can call it a big system, a big application, a big data repository, a big website. That's like a workload. For example, if you look at, let's say, Venmo, that whole platform, the Venmo application, that's a workload. All right. Now, oftentimes these businesses might put pieces of their overall technology estate in AWS and then pieces on Azure. Now you have it in two different places. So you're going to need to move data and communication between those two clouds has to exist. That's where Astera Labs comes in. So they provide the semiconductor that most efficiently connects those data centers and provides for these companies to run these big workloads, especially now that you have AI large language models and you have a lot of AI related workloads. So that's why Astera Labs has become really popular, successful, high growth. Is these data centers have to communicate with one another, and the technology that's doing the best job at it right now is Astera Labs. Good to see you, Tomas. You missed my piece on new holdings. I talked all about Latin America, but maybe you can watch the recording. So Astera Labs, that's where they fit in the big picture. So the big picture looks like it has a lot of potential for Astera Labs. It also comes with risks, right? Can a bigger semiconductor player come into the space and say, we don't need Astera Labs. We're Broadcom. We're going to do it better. And here's how. Yeah, that's definitely a risk. They're 15 billion market cap. So it's not like they're going to stand up to NVIDIA or Broadcom or one of these big, massive companies. What could also happen is one of these big, massive companies says, hey, we'll acquire this little company for 30 billion. And man, then we'll own this piece to the whole data center space, which is the communication. We have the best technology and on and on. And if they did that, I'd be very happy because they'd be like, cool. That's like somebody writing me a check and saying, here you go. Here's a bunch of profit. Thank you. I'll take it. So that's Astera Labs. That's the big picture. Now let's go zero in on their fundamentals, see what we've got. So we went over the revenue growth. We understand the big picture has got a lot of potential. And boy, that revenue growth shows a lot of customers want their product. 200% growth. That's a lot of customers coming to the table saying, get me those Astera Lab semiconductors. I need them. I need them ASAP. I'll pay more. And all that good stuff. Astera Labs sells those semiconductors and they say, glad to sell them to you. And we make 75% gross margins. Whew, beautiful. They're kind of a small business, so their profit margin isn't as high because their back office cost and everything is sponging a lot of that cost. But they still have cash flow and substantial cash flow left over. That's what's exciting. If these guys were to quadruple very quickly, which is going to happen, this cash flow number is going to go from 100 million to 500 million to $1 billion very fast. And this company is going to continue to increase in value. These margins are cranking out profits. They're already profitable. This is a young business. They've been around for 3 years. And actually they've IPO'd recently, but they have financial data for 3 years. So the fundamentals are there. So the big picture is good. Fundamentals are there. Okay, that looks good. Forecast. 14 analysts are keeping an eye on A-Lab. This is a tiny little market cap. What are these analysts doing? Wasting their time on a little cap. Well, it's because they're growing at 200%. That's why. You go 200%, you're going to get people's attention. So best case scenario, analyst is at $125 a share, average 97, worst case 65. So we have a pretty good dispersion on opinions. Everybody agrees they're going to keep growing. It looks like growing is supposed to slow down, but still be quite impressive at 30% growth. And they're going to be $1 billion revenue company in 2027. They're also going to expand their profitability fast. Okay, so they're going to have good profit numbers. So this looks pretty good. Looks pretty darn good. Pretty darn interesting. So the stock looks like it's priced, according to analysts, it's priced close to fair value. Now, with a high growth, small stock, you always need to remind yourself it's riskier. If it's smaller, it's riskier. If it's a company that's looking to disrupt like this, riskier. The payoffs are higher, but it's riskier. We have to be compensated for the risk we're taking. So let me go through my valuation. Okay, so here's my valuation on ALAB. I think they're discounted by 10%. And I'm not too far off from where analysts are. It's based on the free cash flow forecast that I have. They have a very good balance sheet. They only have cash, no debt, by the way. So what's there not to like about that balance sheet, right? So I think their cash flows are they're going to be worth about 18 billion. And this is going to move quickly because as they announce earnings and either their growth is even better or their growth contracts, it's going to change their value. But on cash, I think they're discounted by 18%. And I think their earnings per share, I give them a 48 PE. I can't go higher than that. It's actually priced 11% too high, in my opinion. So it's a 10% discount available. Is that enough for me to buy more shares? At this time, the answer is no. You know, I think the gains have been kind of played into the stock. This was a time to buy here. You know, we talked about the stock, you know, a couple of times a month for the last couple of months. So this stock for me, I would not be buying additional shares. I'm holding my shares. I just don't want to wake up to a world where Astera Labs is a $500 stock and I sold it at 89. I just don't want to wake up to that world. I think that the stock can come down a little bit. If the stock came down to like $80 a share, I'd probably buy more shares. But for now, I would just hold off. Over the 1 day, it's down 7.57. That's really not a big deal because this is a small cap. And this is a stock that I don't think people understand. The average investor, they don't understand the data center all that well. And I'll use an example. Our friends at Dell Computer, right? They are in the data center. And investors were excited about Dell. Oh man, Dell Computer. I know a Dell Computer. I have a Dell Computer laptop. Cool. So let's buy it up because it's part of the data center. And they're absolutely right. It's part of the data center. And they bid up the stock 336%. The problem with our friends at Dell is that they make almost no money on their revenue. It's like, great, you're part of the data center, but show me what kind of profit you make on their product. Astera Labs makes 75% on their product. You guys make 22%. It's terrible. You've been around forever and your profit margin is 4.72. That's terrible. You should get out of this business and get into an Astera Labs business or an NVIDIA business or a Broadcom business. So this kind of shows that, you know, investors go in and get out with these kind of superficial moves. And I think people are moving out of Astera Labs. I'm not. If I'm waiting for the stock to come down in price and I'll buy more shares gladly. But for now, I'm just staying put. Okay. So Saeed, that was for you. Man, so you're looking at A-Lab, Robinhood, CRM. So CRM, I just gave you comments there. A-Lab and Robinhood are priced really high. I love them both. But Robinhood, geez, man, this thing's just been a rocket ship. And it's just priced expensively, man. It's just going up too much. My biggest complaint about the stock is it's done too well. Why can't it be more mediocre? So let's take a look at where I priced Robinhood. And Robinhood is one of those stocks that, man, it's doing great. I still think it's discounted by 27%, but I just kind of like, I'm not buying any more shares right now. I've got $100 and some odd $1,000 of Robinhood. Now, do I think it could go higher? Yes. Would I pick dips? Absolutely. On Robinhood, I'd really be disciplined and buy on dips. It'll dip on you, okay? Robinhood is not going to be a, smooth ride, everybody. Just sit back in first class and nope. You'll see these dips, and these are 45%. And this happened a few months ago. So see how it's on a really nice, the last 2 months, call it up 89%. I would not buy a stock under that condition. I'd be like, oh man, it feels like it's going to have one of these dips, and then I'm going to feel horrible that I bought those shares at a really high price. So I would most definitely I have Robinhood as a stock that I own. If it dips like it did, I bought shares during this dip. I will rebuy on these dips. I own this stock on my 25-year-old son has me manage his fund. He owns Robinhood. It's one of his key holdings. I buy on dips on his fund. So that's my answer to your question, sir. Man, we covered a lot of good ground today, guys. These are awesome companies we're talking about. Isn't stock investing fun? I'm having a blast over here. All right. What's going on, stock market? NVIDIA's selling off a little more. Google's selling off again. Come on, Google. Get it together. Well, I'm going to buy more Google shares today because it's so darn valuable. The business is so important. It's going to be an important business, and I want to be an owner. Okay, so let me take a peek at where the markets are trading. So we have the S&P down 0.37, NASDAQ down 0.66, Dow is down 0.2. Not a big deal. We've had a very good month. Let's not complain about the S&P going up 5.74 over the last 30 days. Beautiful. STC picks. I'm always late. No problem. How are you today? So we've had a really good month. I mean, if you gave me a 5.76% rate of return every month, boy, we could get from that $10,000 to $1 million in 2 years. But it doesn't work that way. We have months where it's like, oh man, the bottom fell out of the market. If you recall, in 1 week, it went down 12%. Over a couple months, the S&P was down 18.9%. So it got really rough, and it was really good to have, the community of investors that we have, because we were just kind of, I don't think I was ever like uncomfortable during this era. It was, if anything, it was like opportunity. All right, cool. Some stocks that I really love, some companies that I really, really want to own. I'm being offered these terrific prices, and then beautiful. And then the market took off. Now here, you're going to hear this lesson, whether you're new to investing or you've been around for a long time. You can't time the market. You time the market and you go, oh man, this market's terrible. And you get out at this point. Well, getting back in is going to be hard. And you're sitting on cash while the market went up 9%. That's why you can't time it. You have to be, for the most part, invested. It's okay to pull some cash out and put it in the capital pile ready as dry powder. So when you do have some of these big pullbacks, but don't go from 95% stock invested of your portfolio to 25. Those are the hedge fund manager guys. And those guys, they're playing with somebody else's money. And if you are playing with somebody else's money, then maybe that's a different game. Instead, you got to stay invested because you're going to miss those days. And that's a painful, painful lesson that you would have to pay for. Mike, thanks for tuning in. And it's been a fun May. Hopefully you made lots of money. I think you did, judging from some of the stocks that you brought up during the month. So that's the lesson, is we got to stay invested, got to stay in the game so we can take advantage of these rises. And FYI, during this rise, all like the professionals on CNBC and stuff, they were all saying how horrible things were during this era, kind of talking the market out of investing more, kind of got to get out, got to get into cash. Look how smart so-and-so is for being in cash. And then the market turned like this, and they're like, well, all the dumb investors made a lot of money. It's kind of like what they were saying. And it's like, no, you were giving people the wrong impression. You should not exit equity portfolios, kind of like all at once, because you're going to put yourself at high risk. You make moves over time, right? If you're 25, you're long-term growth oriented, you're willing to take more risk, you're willing to grow, but you want to stay invested. If you're middle-aged, 40 to, I guess, 50, 55, 60, you're probably like, look, I only want to get wealthy once. I want to, make my hard-earned money work for me at, 24/7. But I don't want to take any unnecessary risk. I've worked too hard for my money. And if you're older, 60 years plus, you still want to play the market. You still want to be part of the action, but you probably have a good part of your portfolio in really alternative asset classes like bonds that don't move a whole lot from a value perspective, but they reward you with income. It's all like having this giant garden of your investments, and they grow. And you have some investments are like trees. You don't have to do much. You plant them in the right place, fertilize them once a year, maybe twice a year, make sure they get enough water, and they grow and they bear fruit. Wonderful. And then you have gardens that have like lettuce that you plant, and 30 days later you're eating a salad. You have a variety of things in your garden based on what you need and what you want to eat, right? Well, investing's like that, is, have long-term mindset, but how much do you need to eat from your portfolio this month, this year? Well, you're going to have to plant different things in your garden in order to have your portfolio provide what you need, both short-term and long-term. When you're young, you're like, I don't need the money. So I just want to go high growth. I want to plant trees that are going to bear lots of fruit. I want the next Meta, Uber. I want the next Microsoft. I want the next, NVIDIA. I want the next so-and-so. And that's where you want to get into growth stocks. So, Saeed. So I bought Uber yesterday. Coinbase. Let's talk about Coinbase. Uber is a great opportunity right now. And the reason for it is, so the story that brought Uber stock down yesterday and today is Tesla is going to come out with robotaxi. Let's follow that thread, and then we're going to come back to what was the second stock? Coinbase. So I'm going to note Coinbase, and we're going to come back to it because my comments are very different on Coinbase than they are on Uber. All right, so Uber over the 1 year, doing good. Year to date, doing great. Over the 5 year, doing good. Uber is the dominant player in ride sharing, and they are a player in food delivery. They're not dominant there. DoorDash is pretty darn strong. But I like the fact that they have a more diversified business than DoorDash. I think DoorDash can become a one-trick pony that is going to find itself on the outside looking in potentially at some point. So Tesla's, hey, we're gonna roll out robotaxi, and conceptually, I get it, but rationally, let's take a look at and compare two things. So we have, see if I can find information on Tesla robotaxi. So this is June 12th is going to be the target launch, right? And these are going to be the cars that are supposed to pick people up. And Bloomberg is trying to charge me money to see that ad. So launch is June 12th. And how are customers going to order a Tesla robotaxi, right? They're going to have to download an app, start using an app that they don't have for a service they've never taken from a company that's never provided that service. Now, Tesla is a car company for the most part. People would say it's a technology company. Maybe. All right. So the first robotaxi, well, the strongest market share company for robotaxi is Waymo. And it took them, 15 years to get to where they're at with looking at all the security, all the safety, having a proven technology and cars that aren't going to harm people, aren't going to wreck into pedestrians and so forth. Where Tesla, I haven't seen that. And, these things going to work. Tesla's saying that their cameras are going to do the job, that they have enough data where these cars are going to be safe. Okay, maybe. They're supposed to launch on the 12th. Tesla's track record is terrible when it comes to launching products. The Cybertruck was late 2, 3, 4 years. Every release date has been late. And now we're supposed to believe that on June 12th, this service is going to launch and it's going to be successful. I doubt it. I doubt it big time. Where Uber, on the other hand, I believe in Austin, they're partnered with Waymo. So if you want a robotaxi, you can get a robotaxi using the Uber app, and you can fetch a ride. If you don't want to be driven by a machine, you can ask, hey, Uber, I want a person to drive me. Perfect. Done. Like you asked me, would I take a Waymo? Yes. Would my wife take Waymo? Absolutely not. If I'm with my wife, I cannot take a driverless car. It's just not going to happen. So the story that Tesla is going to launch and it's going to affect Uber is so overplayed. It's not even registering as a threat to me. It's such a light kind of conviction story. Is this really going to happen? Are people going to put their lives in these machines that haven't really been proven for that long? Maybe a couple people do. And what happens if one of these Tesla vehicles does, run over a bicyclist, runs over a person? Man, it's going to be horrible for Tesla. And it might be horrible for the whole space of robotaxi, frankly. So we'll see what happens. But I'm buying into Uber. I'm buying big time into Uber. Uber is my third biggest position in my portfolio, and I gladly bought more shares. I bought a good number of shares yesterday. It looks like the stock's down today. I'll buy more shares today. Uber, to me, is an obvious winner for the future. Their business is excellent, high growth, they have, that network power when I talk about a company's desirability, right? Let's talk about Uber. All right, move over Salesforce. Move over. Do we have Uber? All right, easy to fix. Let me get the Uber logo, and we'll take a look at Uber. as what is the desirability of Uber, and why do I think Uber is a fantastic business for me to own? All right, so let me scorecard Uber. So from a competition perspective, when ride sharing, they beat everybody. Lyft is so far behind them, not even close. So competition A, network power A. You're seeing that they do food delivery. Their network power has got them the partnership with Waymo. So they do robotaxi with Waymo. So network power is excellent. Revenue growth is okay. It's not awesome right now. Profitability is good and cash flow is phenomenal. Uber is right in the heart of the green. And the reason for it is they're beating out their competition left and right. They don't have any bigger player that's going to take them out. Now the Tesla story, Tesla gets a lot of press attention. So when Tesla does something, boy, everybody reacts. Their stock is not based on fundamentals, it's just based on stories. And obviously those stories are going to cause a negative vibe or negative sentiment towards Uber, which is a great opportunity for a person that looks at the fundamentals behind Uber. So Uber is a very desirable business. If needed, I would buy it at fair price, but right now it's being discounted. So I'll buy more shares. And that's where I put them in the desirability. When we look at the Uber valuation, the good news about Uber being hit by these stories of these naysayers is that it keeps the price investable, and you have these pullbacks that enable me to buy more shares because I still think shares are discounted by 50%. Cash flows are terrific. Cash flows are way up there, almost 10 billion in cash per year. If I look at the intrinsic value, the net present value of their cash flows to today's dollars, they're worth 425 billion, way above their market cap. So based on cash, they're 58% discount. If I look at earnings per share, they're discounted by 20%. So Uber is one of those things where it's like, man, I'm just buying shares. It's going to end up, it's the third most valuable stock in my portfolio. It's probably going to get up there. And, you know, number one is Meta, number two is Google, Alphabet, and number three is Uber. And Uber is the one that's probably getting more capital from me than any other stock. So the other one you asked about was Coinbase. Let's talk about Coinbase. And Saeed, so let's see here. You got a comment on Uber. Exactly. You know, Tesla may be successful with robotaxi, but it's going to take them a long time. Google Alphabet is really smart, really successful, has all the resources you can imagine. It took them 15 years. Tesla's going to come into the market and do it in like 15 days. I don't think so. I think it's going to be interesting to see what they launch on the 12th. And it might be one of those, oh, they launched 3 cars and they're unmanned. Nobody can ride them. They're going to, drive them around for a year, maybe 2, collect data, prove out that it works, and then voila. So we'll see what happens. I think the press is running with the story because they know it's going to get a lot of eyeballs. And the press, you got to be careful, right? Like the press is doing their job. They're creating news and they're creating eyeball attention. But we have to be rational. And I'm being rational with my investments, and separating fiction from nonfiction. So, all right, let's talk about Coinbase. Let's talk about crypto. Crypto's been doing great. And Coin has been doing really, really well. And this stock offers a lot of volatility. Volatility is my friend. Volatility allows me to buy Coinbase when it's really low priced. And kind of like what we talked about with ALAB, right now Coinbase is just, it's had too much of a recent run. It's up 64% in 2 months. It's like, geez, too much of a good thing. I'm waiting for pullbacks. I'm waiting for these types of pullbacks. We will have those pullbacks in Coinbase. It's cryptocurrency. It's the number one cryptocurrency brokerage financial services company. We will have negative stories and it'll bring the price down. But just the, investor beware. When you invest in Coinbase at low prices, it's usually met with a lot of negative stories. So you invest during scary times, right? Buy when everybody else is fearful. But it has proven to be, that's when you want to buy, man. If you buy a share here, very quickly you more than doubled your money because everybody was scared in September. And now more recently, people were scared, risk off in April when we had that big sell-off. Well, that was the time to really deploy capital into Coinbase. I think Coinbase is going to be incredibly successful in the future. I just think that the stock is priced high and you got to pick the dips to invest in it. When I value the company, they're already making lots of cash, but look at that. I have a 5% discount on Coinbase. That's just, it's not a wise place to put, capital into. So the good news about ALAB and Coinbase is that they're flourishing. The stock prices are going up. The cautionary note is right now is not a great time to buy shares because if we have a pretty good pullback next month and Coinbase sells off by 25%, maybe that's a good point to take a look at the stock. So that's my comment on Coinbase. Cool. All right. Man, we've been streaming for 2 hours. STC picks. What's my opinion on Intel? The assets of Intel are worth more than its stock price. And will they make it back as a company? I don't think so. I don't think Intel is going to be what they used to be. They just are so broken. It's going to be hard to imagine that. And all right, that was an awesome stream, everybody. Thanks for tuning in. I appreciate it. Anybody who's not a member, a lot of members were on the stream today. Thank you so much for your support. If you're not a member, I would love for you to be a member. We have a community of 30 plus investors, and we get together on Discord, live streams, investor calls. I provide the tool set that I use to investors. And you can join. Just go to the homepage for my channel, click on the join button. You get more details on that. Take a look. Saeed, it was great to have you. It's great to have you as a new member. And thanks for all the good questions. Good luck with your investments. So everybody, thanks so much for tuning in. It's been a great May, a May of profits. And I really appreciate your attendance. Appreciate your support. Everybody have a terrific day and have a nice weekend. We'll see you.